Federal Reserve will show how the capital of 19 U.S. banks might fare through a deep recession and the second housing crisis when they unveil the stress test results in 3 days. The test will show results for revenue, capital ratios, and profits or losses at each firm over a 9-quarter period. The Fed said in a paper released today in Washington. The results will be released 4:30 p.m. on March 15. Templates included the Fed released today show an array of categories it plans to disclose, from trading and counterparty losses to credit cards and first-line mortgages. The Fed said in a statement that strong capital levels are critical to ensuring the banking organizations that have the ability to lend and to continue to meet their financial obligations even in times of economic difficulty. The supervisory stress scenario is not the Federal Reserve's forecast for the economy, but was designed to represent an outcome that, while unlikely, may occur if the U.S. economy were to experience a deep recession at the same time that economic activity in other major countries contracted significantly. The KBW Bank Index of 24 U.S. lenders has advanced 15% this year as investors bet a strengthening economy will help firms boost earnings. Concurring that the nation's banks may be damaged by Europe's debt crisis helped drive down the index 25% in 2011, its worst annual performance since the 2008 credit crisis. Stress tests date back to 2009 when supervisors tried to determine the extent of losses facing the nation's largest lenders following the collapse of Lehman Brothers Holdings, Inc. and the subsequent financial crisis. Gross domestic product contracted at an 8.9 annual rate in the fourth quarter of 2008. For the current test, however, the Fed provided the banks with 25 variables, including estimates on the GDP, Treasury bill rates, and indexes of consumer prices and home prices. The more severe scenario resumes an 8% drop in U.S. gross domestic product, an unemployment rate as high as 13%, and 21% drop in home prices. 6 banking holdings companies with large trading, private equity, and derivative activities were also subjected to tests of these positions from the global market shock, according to the Fed. The 6 banks are Citigroup Inc., Bank of America Corp., Wells Fargo Co., Morgan Stanley, Goldman Sachs Group Inc., and J.P. Morgan Chase & Co. The Fed said it estimated revenue and losses under the stress scenario based on detailed data provided by the firms and verified by supervisors. The Fed said the test draw on the expertise of hundreds of staff, including supervisors, economists, and markets analysts.
And now for the Greek second bailouts, as the Eurozone group yesterday backed Greece's second bailouts of 130 billion euro, pending on a contribution from the International Monetary Fund or IMF. The Eurogroup includes Eurozone finance ministers from the 17-strong currency bloc, the President of the European Central Bank and European Commission chiefs. BBC reports the meeting followed Greece swapping most of its privately held bonds with new ones worth less than half their original value. Greece implemented the biggest debt write-down in history on Monday, swapping the bulk of its privately held bonds with new ones worth less than their original value. The Greek deal with banks and other lenders is the largest restructuring of government debt in history, clearing the way for the country to receive a bailout worth of 130 billion euros. Under the debt swap, banks and other financial institutions have agreed to exchange their existing Greek government debt for new bonds, which are worth much less and pay a lower rate of interest. According to the Greek government website, the deal involved of 172 billion euros worth of bonds, with investors taking a total loss of up to 74%. The new Greek bond slumped in value on Monday, trading at 71 to 75% lower than face value on the secondary markets. New Greek bonds with 30-year maturities issued with yields of 3.65% were yielding at 13.57%. However, Greece's debt to gross domestic products ratio is also expected to fall to 117%. The chairman of the Eurozone group of finance ministers, Jean-Claude Juncker, who is also the Prime Minister of Luxembourg, made the prediction after the meeting said that Greece would reach that level in 2020. He also added that Euro welcomed the IMF proposals to recommend a 28 billion euros contribution to the Greek facility and now is looking forward to the discussion and the decision by the IMF board on March 15. He said he was confident that the IMF would agree the money, but he was still independent on that decision. Apart Greek, Spain's financial status was also on the agenda, and finance ministers agreed to allow Spain a bigger 2012 public deficit to 5.3% of GDP, higher than the original target but below the 5.8% Spain originally wanted. Jean-Claude Juncker said the more important figure was the target of a 3% deficit by the end of next year. Earlier this month, Spain said it would miss a deficit target of 4.4% of GDP for 2012 agreed with Brussels. The country was earlier praised by Germany's finance minister Wolfgang Schäuble. The country is planning 30 billion euros of spending cuts this year at a time when its economy is contracting. Under the new rules, severance pay will be slashed and will be easier for firms to opt out of a national pay agreements negotiated by unions.
Well, as the Eurozone has been in a financial turmoil for the past several years, the French President Nicolas Sarkozy yesterday gave a speech with a surprising new backtrack of the Eurosceptic stance that he is presenting to the public. After an initial bid to run for re-election as self-styled savior of the euro, Nicolas Sarkozy has launched a bid to shake up his lackluster polling numbers with a surprise new Eurosceptic stance. With barely 6 weeks to go before the first round of voting, and with the French leader's socialist opponent, François Hollande, is still front-runner for the presidency, Sarkozy struck a strident with tone in a Sunday rally. He threatened to pull France out of the Schengen Open Borders Agreement unless the bloc makes progress on protecting EU borders from illegal immigration. He also demanded the European Union adopt measures to fight cheap imports, warning that France might otherwise pass a unilateral buy French law. He said that he is a European believer, but the Europe had to change. Speaking during the televised interview in the run-up to the country's presidential election, he also described Europe's border as a colander. Sarkozy said having Europe is to protect the European, not making the European more vulnerable. He added that having Schengen is for the European borders can be defended, not for Europe becomes a colander. The Schengen zone applies to all 27 EU member states except Britain and Ireland. Last week, bloc members Austria, Belgium, Britain, France, Germany, the Netherlands and Sweden called for an action plan to stem the tide of illegal immigration into the Union. The EU's Executive Commission is due to submit in May a report on the functioning of the Schengen system. Sarkozy also used Monday's television appearance to reiterate his latest campaign proposal to establish a European Buy Act, which would guarantee the European public funds are only allocated to companies which produce goods in Europe. Sarkozy's right-wing supporters were delighted, both in the large conference hall in Paris suburbs, where his speech received an ecstatic reception, and in media interviews and on the internet message forums afterwards. But the left was quick to attack when they saw as populist stunt Holland's campaign manager Pierre Moscovici, who is Holland's campaign manager, said that he felt that he was not listening to a French president because a French president always wants to build Europe, push it forward. This was a conservative British Prime Minister. Moscovici said Britain had led opposition to the Schengen Accords, under which most EU members agreed to abandon border controls between the states, and said Sarkozy's threat was a phenomenal step backwards.
Still stay with the European issues, but now on the Chinese side, as a Chinese senior central bank official said yesterday that China is confident that Europe will overcome its problem and will continue to invest part of its foreign exchange reserves in European bonds. Yi Gang, Vice Governor of the People's Bank of China, or PBOC, and head of the State Administration of Foreign Exchange, said China believes that Europe will ultimately overcome the debt crisis through their own efforts, as well as with help from the international community. China will continue to be a long-term and responsible investor in Europe. He was speaking in response to a question on China's holding of euro assets, including Greek bonds, at a news conference during the annual parliamentary session. Yi added that China will continue to diversify its investments in foreign bonds while keeping risk control a top priority. The PBOC, under its governor Zhu Xiaoshuan, has been following a prudent policy. However, China is also concerning over safety, liquidity, and potential revenues that are the three major factors affecting government's thinking when it tries to diversify the foreign reserves portfolio. But the country's Eurozone bonds did not register a loss, therefore, instead the revenue increase was higher than the local inflation rate, despite the uncertainties of the debt crisis and economic recovery across the region, which proves diversification worked well. China had $3.18 trillion of foreign reserve by the end of last year, the largest in the world. About one-third was invested in U.S. Treasury security, and about 20% has been invested in euro-denominated assets. The PBOC said in a statement on Monday that it will make continued efforts in 2012 to manage the country's reserve assets with new ideas and in a more effective manner. Nicola Casarini, research fellow at the EU Institute for Security Studies, said it means that China will further diversify away from the US dollar and invest in euro-denominated assets. Yi's remarks indicated that China would rather invest in industrial and strategic assets in Europe rather than buying more bonds. Casarini agreed with Yi that the Eurozone crisis is now showing signs of improvement, spurred by the second installment of cheap liquidity by the European Central Bank and the policy of austerity implemented by the new Italian government. Wang Tao, head of China Economic Research at the UBS Securities Co. Limited, said the systemic risk of the Eurozone decline as the Greek Finance Ministry announced it had received sufficient participation from private sector creditors on Friday to proceed with its proposed bond exchange program.